The benefit of multi-asset investing is that you're not just invested in one asset class or single area. Multi-asset investors have the ability to move money between asset classes, countries, currencies, and now with our True Potential portfolios, a new level of advanced diversification, which is around fund manager style. Timing the market perfectly is difficult. This is why we encourage long-term investing and impulse saving upon price weaknesses when these are evidencing in the market. All of this can help you as an investor to enjoy the fruits of your investment experience further down the line. The True Potential portfolios now have over 1.4 billion invested since we launched in October 2015. So we would just like to take this opportunity to thank you for your ongoing support. Now, looking at performance over the month, we're very pleased with the results. All portfolios are showing a positive set of returns. Performance since launch is also showing double-digit figures for those portfolios with increasing levels of risk. What this highlights is that investors that have taken on higher levels of risk throughout this period of uncertainty have been rewarded. However good the outcomes in the short term, it's important to realise that investing is more like a marathon rather than a sprint. One of the key areas that we look at is risk. Both True Potential and our fund manager partners are very aware of risk levels within the portfolios and the funds. What we aim to offer is a good risk-adjusted return, and what we mean by this is aiming to maximise returns within a specific risk band. We will never take more risk than is necessary, and certainly not sufficient enough to push an investor out of their risk category. This is something that we continually monitor. There is a growing sense that inflation will pick up in the months ahead. The rule of thumb is that a 10% devaluation in sterling leads to a 1% increase in inflation, but there are a host of factors that can throw the balance one way or another. Inflation may also rise due to the simple fact that the commodity price collapse is coming up in January 2017. And what I mean by this is the anniversary of the commodity price collapse. And this in its own right may push inflation up. Some of our managers use purchasing power parity models, also known as PPP, to assess the fundamental value of a currency. What they are suggesting is that these PP models are indicating that sterling is now undervalued, but may stay weak for longer due to uncertainty around Brexit. Some of our fund managers hedge currency risk and see it as an opportunity to be exploited. Changes which have taken place this month lie within our cautious portfolio and reflect the need to optimise on risk. Every month, we aim to optimise on all factors, and risk is a key element in the mix. What we've done this month is we have reduced our positioning in the True Potential Allianz Cautious Fund and placed the proceeds into the True Potential Schroders Cautious Fund. Looking at the rationale for this, the True Potential Allianz Cautious Fund currently has a higher measure of risk or standard deviation. Taking risk at the start of the year was beneficial for price gains, though now we are reducing exposure as it will help lower interest rate sensitivity risk and help to mitigate currency volatility risk. Both of these effects are higher within the True Potential Allianz Cautious Fund compared to other funds in the portfolio. The reason for the increase in the Schroders Fund is that it brings added fund manager diversification, lowers bond exposure, and the higher weighting in cash helps us to manage downside risk. Looking at the rest of the True Potential portfolios, all allocations have been kept the same, with optimising across our 4 factors continuing to be paramount within the portfolios.